Okay, we reviewed most part of the 3 chapters that will be on next Tuesday for midterms, and we have a little bit of the last chapter, 21st, to review on the last 2 methods used to evaluate long-term assets, projects, investments. Right, so we went over the first 2 was payback period, rate of return, and then in the middle part of this chapter, first we went over the concept of the time value of money. Right, so the reason why we introduced this middle portion here is because some of these long-term assets projects last for more than 5 years, could affect the business operations for 10 years to 20 years. So it's important to trace back to actually discount the returns of these potential projects into its current value, and then we compare different projects based on understanding which ones has the higher return than the others. Okay, so in this middle section here, really is helping the last 2 methods, NPV and internal rate of return, to make evaluations for some of the long-term projects that are relatively even longer in time frame compared to shorter time frames, 3 to 5 years, long-term projects where you can use payback period, rate of return. Usually for longer ones, we would use the 3rd and 4th method introduced in this chapter. So the main difference between present value and future value is what? Main difference between the $1 you have now and perhaps $1 5 years from now. What's the difference between these 2? How much the dollar is worth, and also the time frame and the interest in the middle that you're generating based on the principal amount. Right, so before we went into what is PV factor, FV factor, really the main concept here that you have to know is the differences between these 2, between the $13,383 and the $10,000. Right, the difference is the interest you earn as time goes by. So you don't have to deposit additional money in the account just based on the account's given interest rate. You deposit $10,000 here, and then perhaps 5 years from now or 10 years from now, based on the interest rate, you can get additional fund just as time goes by. Okay, so present value and future value, the main difference here is the interest that you're generating in between. Okay, and then we calculate future value, present value. There are 2 different types that you'll need to know. So we may have just a one-time investment amount. You deposit it today, and you're getting that dollar amount 5 years from now or 10 years from now. This is what we call lump sum investment. Right, so as opposed to this, the second investment type you need to know is the annuity type. Remember, recurring amount that you're either depositing in an account or recurring amount that you're tracing back to what its present value worth. So if we want to calculate future value for lump sum investment, one-time investment amount, let's say you deposit $10,000 in an account and you're aiming at getting it 5 years from now. So you're not depositing more money into that account, just simply that one-time investment, $10,000, and it runs by an interest rate 6%. So if you want to know how much it's worth 5 years from now, we refer to this future value factor table. So you go through 5-year period, and then you trace that future value factor to 6% interest rate. Right, so what do we do with this 1.33? That factor, in order to get the future value of that $10,000, you use that factor to time that $10,000. Remember? Okay, so this is the future value of a certain one-time deposit amount. You trace to this lump sum investment table to find the future value factor, and then you time the principal amount. Okay, so remember when we calculate future value, present value, the 3 important factors. What is the principal amount, which is in this case is $10,000? What is the time frame for the investment? So if you mirror this to long-term assets projects, what will be the asset's lifetime? Okay, and then deposit will be what is the initial cost or what is the return? Interest rate, what is basically the differences you're generating between present time frame and future time frame, right? So the differences. So this is a one-time investment example. Again, future value factor times the principal amount. Now as for annuity examples, if you break down that $10,000 deposit into 5 years, every single year you have recurring deposits, $2,000, $2,000, $2,000, $2,000, and you'll need to refer to another table, annuity table. Right, so this is just because the nature of investment is different. So you refer to different factors in order to get the future value of this deposit amount. So some portion of the $2,000 get interest rolled for 5 years. A certain portion only rolls interest for 4 years, and then you have okay, sorry about that. Now where was I? The $2,000, if we break it down to 5 years, so the deposit amount, the interest will be rolled not purely for that $10,000 one-time deposit, but we break it down to 5 different smaller investment amounts, $2,000. So overall, the future value compared to the previous example will be less in dollar amount because some portion of it hasn't been accumulating interest for not altogether 5 years. Okay, so this is an annuity example. If you break down investments recurring every single year, you refer to this annuity future value factor times the principal amount, again, $2,000, to get the future value for these deposits, which broken down into 5 different years. Okay, so future value, as opposed to this, if you're getting present value based on a dollar amount that you know you expect to get certain years from now, you would be referring to the present value table to get what is that certain amount of money you're getting 5 years from now, 10 years from now, what is it worth as of today? Okay, so if we just rephrase that example, you expect to get $13,383 5 years from now, and the account interest rate is 6%. So you would trace back that dollar amount, discounted by this present value factor, times the dollar amount that you're expecting to get certain years from now. Okay, so if you trace that back, discounted to current date, the value will be $10,000. So just another way to look at the previous example. Earlier we were talking about depositing $10,000 and then getting this 5 years from now. Now this is just the opposite of that story, getting this dollar amount and how much does it worth as of today. Okay, so this is again also a one-time investment. As opposed to this, you can also get annuity values. So remember we went over this lottery example. If you have 3 options to choose from, you can either get $1 million now, $150,000 every single year for 10 years, or $2 million 10 years from now. So if you want to choose from these 3 options, we discount the value of those money, those returns, to its present value to compare which one is higher than the other. Okay, so option 1 is already this present value. You don't have to worry about that. Option number 2 is an example of annuity. Right, if you get $150,000 every single year, 10 years from now, if you trace back, discount that value to its current date, we'll refer to the present value annuity factor, use this to time the $150,000. So as of today, this is the total returns worth. So compare this with the first one, this is actually higher. And then option 3, getting $2 million 10 years from now, this is an example of lump sum investment. Right? You don't have additional deposits in the middle. So we refer to another table, which is the PV factor lump sum investment, and then same process, use this factor to time that $2 million to get its current value as of today. Okay, so what we're doing here, this concept here is leading to the long-term assets projects. We'll be tracing back, discounting the returns, potential returns of this asset based on the machine's operations, equipment's usage in the business, trace it to its current value, and then compare which return is higher than the other to find the investment project that the company really wants to go for. Okay? Now this example is just the same lottery example, just switching to different numbers and then different time frame, percentages of interest. Basically the concept is the same. 7 years from now is a lump sum example. You have a current value, the second option, and the first option is getting a recurring amount at the end of each and every year. Okay, so just remember that annuities, lump sum investment, you'll be referring to different tables. You'll be using different factors to find its present value or future value. Okay, so the last section in this chapter, discounted cash flow models, continuing the concept of lump sum investment, annuities, and then we use this concept, apply it to investment projects, long-term assets. Okay, so net present value, this method here, in order to choose from different options, at least the net present value has to be a positive number. Okay, so the decision rule for this method is it has to be at least a positive NPV, and then we consider further which project's NPV is higher than the other. Okay, so what is NPV? Again, the differences between the initial cost you spend on an asset. For example, if you spend $1 million to purchase a certain machine, that's the initial cost. You compare that against all the potential returns and you discount it to its current value. The differences between that present value and the initial cost. This difference is what we considered NPV. Okay, the money that you're spending on the asset, compare it against the expected return, and you all trace it back to its present value. The differences between these two is what we call net present value. So the decision rule for this, again, at least it has to be a positive number, and then you compare between different projects, which one of them gives you the highest NPV. Okay, so let's take a look at the example we went over. Assuming you have these two projects to choose from, one of them gives you an equal return. You expect it gives you an equal return every single year for 5 years. The other project has unequal returns, but also its lifetime is 5 years as well. So if we want to choose from these two, just by looking at these anticipated numbers is not enough. Okay, so if the initial cost for these two projects is the same, we'll be tracing back these numbers to its present value and then compare which one has the highest NPV. Okay, so this one is the concept of annuity. It has the same dollar amount every single year. This one here, you'll be tracing it back to its current value. Think of these as individual lump sum investment. Okay, so the first one, CD player, what we did was refer to the table. The textbook example gives you the interest rate 14%. This is what the company is aiming at getting, desired rate of return. And the lifetime of the asset is 5 years. So when you go to the table, you're referring to 5 years period and then 14% of interest rate. So assuming the FPV factor is 3.433, which you refer to, and you time this by the return. So this number here altogether is the net cash inflow you're expecting to get based on investing in CD players in the business. And again, we compare this return with the initial cost. So this tells us what? It tells us the net present value, which is a positive number. And then if we have another option, then we will compare this with the other project's net present value. Right? But if this is the only project, then it already tells us that this is a positive number a company can consider to invest in this. Right? Okay, so if we compare this against the other one, since it has unequal cash inflow, we think of those as individual lump sum investment. Because remember the idea, the concept of annuity means that recurring amount and it has to be the same amount. Okay, so only the first project with the same return we refer to the either PV factor or FP factor of the annuity table. Otherwise, for this example here, think of it as separate lump sum investment. So the factor you will see that you're using is different for each and every year. So the first line here, year one, you think of having that return a year from now, $500,000. So you refer to the table, first year, 14%, whatever PV factor is. Use it here, 0.877. Okay, second year, the same concept, it's just that you're referring to the second years. Same 14%, a different PV factor. Okay, so on and so forth. Add them together, this is the total net cash inflow you're getting. compare against the initial cost, again, $1 million. So this one is also positive, and it's actually higher than the other one. Right, so if this is the only two options, you'll be choosing this one instead of the other.
They have different investments, which use like profitability index?
Yes, so they have different initial cost. This case here, both of them is $1 million, right? So if they have different initial cost, we'll be adding to this decision rule is the profitability index. So basically what we're doing is, this is an example of 3 different projects. All of them are giving you a positive in NPV. You can see that the investment cost, which means the money that you're spending initially if you purchase the asset, is different across all 3 projects. So you can't just compare the dollar amount here because it's not comparable. The initial cost is different. So we'll be using the net cash inflows divided by all these projects' initial costs to find this profitability index, and then we'll be choosing from the highest one. So what this index means is per dollar of investment, how much net cash inflow you're getting. Okay, so the previous example, both cases, CD player, DVRs, they have initial investment the same dollar amount, $1 million. So you'll just be comparing the NPVs. So in this case here, if the initial cost is different, you'll be using profitability index together with NPV method to find the one that has the highest index. Then that will be the one to suggest the company to invest in. Sorry about this. Okay, any questions so far on this third method? This tool here, together with internal rate of return, is slightly more complicated than payback period and rate of return. Okay, because this is actually more comprehensive. It's looking at a longer time frame's return. And since it has a longer time frame, we want to know what is it currently worth. And across different projects, we compare them to find the ones that really gives us the highest return. And then again, in case initial cost is different, you compare these different projects. Also, you add in profitability index, not just looking at its NPV dollar amount. Okay, now remember sometimes assets, especially long-term assets, has a residual value at the end, meaning after using it for 10 years, most part of the value of the asset has been used, but perhaps you can also sell it or trade it in for cash, right? So in the case that assets have residual value at the end, we will look at that residual value as additional return. So meaning after using the asset for 5 years, you can still sell the asset for $100,000 if that's what you're expecting in the business. Then we think of that $100,000 as an additional return you get after the 5th year of using the asset. So we'll be tracing that to its lump sum investments, dollar amount, the 5th year, and again 14% to find the PV factor, times it to the asset's residual value. So that together is a positive toward the net cash inflow. You add them together with the other recurring return that you're expecting to get from the asset. Then you compare that with initial cost. Okay, so assets has residual value that adds on to net cash inflow. That's actually a positive to the business because you can sell it for a dollar amount after using the asset. Okay, that's pretty much about all about NPV that I want to mention. Basically, again, the decision rule is having a positive NPV. If you have multiple projects to consider, trace back to if it has the same initial cost, then you can just compare NPV's dollar amount. If they have different initial cost, add in also profitability index to find the highest profitability index. Now, in case the assets doesn't have a 0 residual value, it has a certain dollar amount of residual value that's considered additional net cash inflow. Okay, so you add it on to other returns net cash inflow, compare that against initial cost. Okay, now internal rate of return basically is just another way to look at how profitable the project is across across different projects, we'll be comparing which one has the highest IRR. Okay, so what IRR means is that earlier we just used the desired rate of return that the company is expecting to get, use this to trace back and discount all these returns to its current value. But in IRR, we're basically leaving this I blank, and this is the part that we're trying to figure out. So what does I mean is the return, the unique return from this particular project. Okay, so earlier we were comparing NPV. Here, this method will be setting NPV at 0 and then trace back to see what is exactly the return that we're getting from this particular project and compare across different projects to see which one has the highest I. Okay, so if we use the same example that I gave you earlier on the CD player DVRs, if they have a positive NPV, that basically means their rate of return for the project, if they use IRR as a tool, it will be higher than 14%. It will be something like 16% or 15% in case they have a positive NPV. So basically it's just representing this positive NPV in a ratio form. Okay, so we set the NPV as 0. Take this as an example. If we have initial cost $1 million, we assume every single year we have a certain return on about $300,000 for 5 years. Okay, so this is a concept of annuity. To get the IRR, we set the NPV as 0 and then put the return that we're anticipating to get times the PV factor, which is the one that you'll be tracing to the table to find the I. Okay, so this part here, you'll be going through the fifth year, and then you will use that, if you rearrange this equation to find the closest factor, which is closest to 3.274. If you trace that to the table, you find the IRR for this project that's worth about 16%. Okay, so again, what this tool is doing is that it's setting the NPV as 0, trying to represent NPV in a ratio form. So if the problem tells you that the company's desired rate of return is 14%, whether or not we want to invest in this project depends on whether this IRR is higher than 14% or not. If it's higher, then we invest. If it's lower, then we reject it. Yes, you'll definitely be given a table for any of the problems that I ask you to do, present value, future value. Okay, so in case you can't find a number that looks exactly this close to the factor that you're getting from the equation, you can just find a range. Say it's between 60% or 17%, so like one of the homework problems. Okay, as long as the range you choose, the number actually does fall between, then you're good. Right? So again, just by looking at this factor, you can't really determine how well the project is. What you need to do is, in the problems, that will definitely let you know what is the desired rate of return that the company is aiming at getting. So if this is above it, then this is a good project that a company can consider to invest in. If it's lower, that basically means the NPV would also be negative. Okay, so both of these tools should agree with each other. If one of the case you got an NPV as positive, then here, whatever the IRR you get should be higher than the company's desired rate of return. If the IRR you got is lower than 14%, then definitely when you use NPV, you're also getting a negative NPV. So both of these tools, the conclusion you get from both of these methods should be the same. Okay. All right, so I basically summed this up already. Decision rule is to compare the IRR against whatever the rate the company is desiring. Is setting in place for this season. Okay, make sure to go through this example too. So this one, the Snow Park Lodge, the previous two methods we also use this example. Last two methods we also use this example. Basically it ties everything together. Okay, so this is also a slightly more complicated example. So if you understand this, then I'm pretty sure that all the other problems you'll be going through it pretty easily. Okay, so this is a case that it has residual value of the asset. It's also considered an additional net cash inflow Don't forget to include this together with all the returns present value. Okay, now IRR, in case I give you a problem like this, you'll definitely need to refer to the table just to find which one gives you the factor that is closest to that 5.079. Okay, questions on the third and fourth tool? Nope. All right, let's review some of the concepts in this chapter. So what is the first step of capital budgeting? Well, capital budgeting means investing in an asset, so it would be identifying the potential projects that the companies may be able to invest in. Right, some of the options. Remember that CD player example, DVRs? They're looking at which areas that they need to improve, so these are the potential projects. And then what they do is use that 4 tools to analyze them, to find which one has the highest profit, highest NPV, highest IRR, right? After carrying it out, they need to evaluate it on a seasonal basis or at least a yearly basis to see whether they want to go forward with this project or not, to see if their return is actually the same as the estimated returns. Okay, which one of the following methods does not consider investment's profitability? Payback period, what it gives you is just the number of years, right? So it doesn't really consider all the remaining profits you're getting after you got the returns that covers initial cost, right? So the disadvantage, the criticism for this method would be, even though sometimes you get the return in a shorter time frame, doesn't mean that the profit is higher than the other project. Okay, so this doesn't consider profitability as payback period tool. Okay, which of the following is the most reliable method for making capital budgeting decisions? NPV method considers time value of money. It's more comprehensive compared to payback period and ROR. ROR is rate of return, or using operating income. Those two, A and D, usually is used for projects that last for about 3 to 5 years. B, post-audit, is not really a method. It's basically just evaluation of projects. Okay. All right, it tells you that your rich aunt has promised to give you $2,000 a year at the end of each of the next 4 years, okay, to help you pay college. If you want to calculate the present value of this gift, which one would you choose that represents this statement? Annuity factor, I equals to 12%, year is 4, and it should be the present value of it. Okay, so not the future value, because remember that it promised to give you $2,000 every single year for the next 5 years. If you're getting the present value, you have to use PV factor. Okay, what is IRR? Which one seems like the definition? Interest rate at which the NPV of the investment is 0. So remember, we set it as 0 on purpose because we want to represent the positive or negative NPV using a ratio form. Okay, so it's A. Okay, which of the following affects the present value of an investment? The type of investment, and then we also have the number of time periods, the interest rates, so these basically are all 3 of the factors that will affect present value or future value of any investment. Okay, so yes, it's all of the above. Okay, in computing IRR on an expansion at a certain resort, which of the information will be considered except which one would not be considered, basically? IRR. So calculation of IRR, which one is not used? Well, A is for sure you have to use some sort of present value factor. Predicted cash inflow over the life of the expansion also needs to be considered, right? depreciation on the assets built in the expansion, right? What is depreciation used for? Which of the four uses depreciation? Which of the four uses depreciation? Payback period, rate of return, NPV, IRR. It's the rate of return. Remember, rate of return is basically an accounting measure. Remember, rate of return, we will use operating income, average level of assets investment. Remember that divided by 2, the beginning assets cost plus any residual value divided by 2, and then operating income for whatever years, right? Times 6 years, add them together, divided by 6, and average of that. So the difference between operating income and cash inflow is the depreciation portion. Right, so depreciation on assets built in the expansion, we consider this in rate of return, the second method. Okay. Now, this problem here tells you that both projects has a positive NPV, but the company only chooses to invest in one of them. This I haven't went over in details, but maybe you can try to guess which one is the answer. Both of the projects tells you it's a positive NPV. At the end, the company only chooses one. What do you think would be the reasoning behind this? Payback period is greater than the warehouse project's life. The internal rate of return of the warehouse project is less than the company's required rate of return. The hint here basically is that both of them has positive NPV, which means both of them, IRR, will be higher than desired rate of return. So really here they're exercising capital rationing decision. This is a little far from all the number tools. What this means is at the end of evaluating all the investment projects, remember a company only has limited resources. Just like how they use the machine, they can only either produce the regular DVDs or special ones. So they need to use the most of their resources, basically choosing the investment projects that is more urgent than the other. So since both of them gives you positive NPV, which means that both of them is a possibility to invest in. Okay, so the one that they choose basically is going for the one that is more urgent than the other. This is one of the reasoning approach. So we call it capital rationing, right? So if this problem gives you a detailed numbers of IRR, of NPV, then you compare which one is higher than the other. Okay, the last one here, this is relevant to rate of return method, the second one. So if it tells you that the cost of the investment is $550,000, residual value is $75,000. To calculate rate of return, the numerator and denominator. Numerator part is the operating income. Denominator is assets average value. Okay, so this answer I already gave you. Basically, you're understanding per dollar of average investment in the asset, how much operating income on average on a yearly basis that you're getting. Okay, so denominator would be the asset's average value. If this question was asking you the numerator, it would be operating income, average operating income you're getting every single year. All right, questions for me? Now on the exam, next week we'll have a portion just like the first midterm. So some of the multiple choice questions, some of the short problems. For short problems, I'll focus on the last two chapters, short-term investment decisions, long-term investment decisions. Okay, now short problem for this time, it will only be based on homework and slides problems. I wouldn't give you any other problems that you haven't seen before. So basically, some of the numbers I may change, but the structure will be the examples from either the slides or homework. Okay, so make sure to review all those, especially for short problems. Okay? And you had a question, right? Interest rate. You're talking about the previous example that I just went over? Times the PV factor. That's the time when you're calculating NPV. So that's additional net cash inflow. Okay, any present value factor is only used for the third and the fourth tool, NPV or IRR. Okay. All right, again, number 2 pencil calculator, make sure to bring it for next exam. Again, slides, exercises, homework exercises, all the short problems will be given from those problems, choosing from those. Now we'll try to make it easier for you, so I'll try to give you some hints on calculations. I usually don't allow cheat sheets, and especially for intro classes, usually it's not appropriate to give out cheat sheets or to give the entire set of formulas because it's already an intro class. Okay, so this has to be unified across all different sections, so I can't really give you additional help on that. What I can tell you is that the problems, I'll try to underline some areas that will give you some hints on calculations. Okay? Okay, and I also listed the bullet points that you definitely have to go through as a checklist. Some of the things that I didn't mention here, then you can drop it. Okay? Some of the qualitative factors I wouldn't be focusing a lot on the qualitative factors of going through investment projects, mostly be focusing on numerical side. Okay, you all look gloomy now. Are there any questions for me before we go on to new materials? Table, definitely. PV factor, FV factor, you don't have to memorize those decimal points, so I'll give you the tables. Okay? Yes, this is already on Blackboard under course documents. Okay? Yes, the answers are there. Right, so when I go through the chapter, some of the exercises that I didn't go over, you don't have to worry about it. Just focus on the ones that I posted. Okay? All right, we still have some time, so I want to go over just a few sections of a new chapter, Master Budget Responsibility Accounting. Since we already lost a week, and we're not really doing makeup classes, so I'm just going to postpone some of the classes to further. And if we don't have time, we'll probably not be going over the exams after the exam. So if you have questions, just come to me during office hours, okay? If we run out of time. If we do, then definitely I'll go over the exams with you. Okay, so this chapter here still continues on some of the concepts that we went over in the previous chapter, especially on long-term assets part. Remember we did the evaluations on comparing initial cost with all the expected returns from later years. That concept itself is already a type of budgeting. Okay, so that's basically the middle portion of the entire master budget where we compare what is the money that we're spending, what is the expected return we're getting. That's simply the capital budgets, capital investment budgets. Okay, so it's an important component of the budget, which we already took it out as an entire chapter and covered in the previous 21st chapter. So in this chapter here, we'll be linking that with all the other areas of budgeting. So we're not just doing long-term assets budgeting, we're also doing sales budgets, cost of goods sold, inventory budgets, we're also doing cash budgets, the entire financial statement budgets. So we call the entire set master budgets. We'll be going over the components, linking this to the previous chapter's concept. So what is the point of learning this? Companies need to plan, needs to control some of their actions. Okay, so just like you and me, typically 2013 is right around the corner. Perhaps January 1st you'll sit down and make a whole list of your yearly goals, right, objectives. So same for companies. They also need to sit down, especially managers, department heads. They need to work together and plan out the goals in the next season and potentially in the next year or 5 years. Right? So these are the strategic and operation plans that companies want to set, and then they turn this into numerical numbers. Right? So if you set the goal that you want to pursue a further degree, you probably need to spend 3 more hours on studying GREs or GMATs. Right? If you want to lose weight, you need to jog more, cut down the snacks. Right? So just like you and me, we set the plans, companies also need to set the plans and specifically on their operation cycle, then turn these wording goals into linking it to numbers. So what's the potential payments that they need to make? What is the expected returns that they're getting from these? So just like the same concept that we covered in Chapter 21, we're now using that concept for all the other areas in the operation cycle. Okay, so specifically the process here, we start from developing the strategy, the middle one. So companies may want to expand their business from US to other countries. They may want to introduce customers new set of products, a series perhaps. So these strategies, these goals, we then link it to a detailed planning cycle. So basically, what is the revenues that we're expecting to get? How does it do in marketing? What is the expected expenses in different areas that we may need to spend on in order to make that plan feasible? These planning side is basically linking these strategies into numbers. And then finally, we carry out the ones that has, remember, like the highest NPV, the highest IRR. Those are the projects that we go for. Then we do evaluations, controls on these strategies, these plans. Okay, so this is the general cycle of budgeting. Again, starts from developing the strategies, the areas that the company wants to invest in, wants to improve. Then we understand what are the numbers that goes together with these plans. Revenues, expected returns, expected cost. After carrying it out, we act on the plan, then we do controls. Basically, this goes to that post-audit concept, right? Evaluating on a yearly basis whether the return is really as we anticipated, or do we have to cut down the budget in certain areas for next year. Okay? So the benefits of doing budgeting, remember that companies has different departments. It forces managers to set plans and work together as a team. So just think about introducing a new product. Besides the idea, the creativity that goes into the product, you have to take care of the materials in order to produce the product. So you have acquisition department purchasing materials, you have producing department putting together the materials, assembling it, and then what happens? After producing the product, the whole purpose of producing it, you need to sell it. So you also have sales department. Then you have marketing department to advertise the product. So after that, you also have customer service that needs to take care of all the customers' responses. Right? So all of these are different departments. They have different functions. Budgeting helps them to work together as a team, to link all the ideas together, numerical plans. After carrying out the plans, introducing the products, they also need to have feedbacks from customers. They need to understand whether the money that they're spending, the return they're getting, really matches with the budget. So it also serves as a benchmark to compare against after you carry out the plan. Okay, so this is the theoretical background, the grounding, the reasoning why we're doing budgeting. It serves as a coordination team. Basically, it helps the managers from different departments to coordinate together, communicate, and also the budget serves as a benchmark. Now let's take a look at this. After doing budgeting, this is just a glance of after learning this entire chapter what we're really looking at. After carrying out the plan and comparing it against budget, this is a performance report that later on we'll be learning how to do one of these. Okay, but just by looking at this, what kinds of information can you tell from this in terms of actually carrying it out compared against the original budget? We have it probably not say left over, because if you look at the actual numbers and then you compare it with the original budget, that means we're actually missing certain dollar amounts, right? Because we over budgeted, yes. So you originally planned to get operating income $487,000, but at the end, this is the actual number you got. So it's actually slightly lower than $3,000 lower than the original budget. And where does that difference come from, mainly? You can see some of the numbers are exactly the same, right? Variable expenses are different, and variable expenses are different because of Chapter 19. You have different types of costs. Variable expenses will be different because the number of services or the number of sales is different, right? So your expected service you're expecting to provide it to 20,000 customers. At the end, you only got 19,000 customers. So you have lower number of services, lower service revenue, which is why all the variable costs are lower than expected, right? Because variable cost floats with sales, floats with service revenue. Okay, so as opposed to that concept, what about fixed expenses? It's exactly the same, right? Remember, fixed expenses usually doesn't change unless we bump into a next relevant range, right? We expand the business so that it really needs to depreciate a lot more than before. Otherwise, even though service sales are not the same as what we budgeted, this portion here, which relates to depreciation, relates to full-time employees' salary contract, will still be the same. Okay, so this is just a heads up for what we're trying to do at the end is getting to one of these. Doing one of the performance report, understanding what is our goal, and then after carrying out the project, what are the differences, the variance between these two. Okay, let's take a look at the detailed components of a budget. We usually break down the master budget into 3 main categories. We have operating budget as a first bullet point. Second, we have capital expenditures budget, which we actually covered in the entire chapter in the previous chapter. 21st chapter is all about the second bullet point, capital expenditure budget. Third, we have financial budget, which plans to raise cash, paying debts. Just by looking at the name of these different components of budget, does it remind you of any statements? Income statement links to first one, right? What else? Balance sheet links to the third one, but then if you look at the breakdown of these 3 bullet points, it's actually exactly the same components in statement of cash flows. Remember, statement of cash flow, the first bullet point, first section is about operating expenses. Operating expenses, cash receipt, cash payment on expenses and revenues. The middle part is on the investment of the assets, so the money we spend on purchasing the asset, the money we spend on trading in the asset, what we receive from selling the asset. Financial budget part mirrors actually the statement of cash flows, the last section. So if you sell any stock, if you borrow money, what is the debt that you actually received or paid? These 3 bullet points, the component structure is really exactly the same as statement of cash flows. Okay, but the first part here, what we're doing in operating budget is understanding what is our anticipated spending on those temporary accounts. So remember, revenues, expenses, all of these accounts closes in a year. They're considered temporary accounts. So we're trying to set a plan and anticipate what is our expected sales revenue, what is our expected inventory expenses, and then at the end, there's also other expenses, right? Rental, utilities, other expenses other than inventory costs. So altogether, the first bullet point, the goal we're trying to get to is the expected income statement. Okay, so this is the first part of master budget. Second, capital expenditures we learned in the previous chapter. So this chapter here, we're really not focusing that much on the second bullet point, just the first and the third. So third one here, financial budget, links to all the other accounts that we haven't mentioned in the first 2. So basically anything related to debts, anything related to stock market transactions, those that we will plan it out and see what is our goal for next year. All those numbers factors in the third financial budget. Okay, so basically this entire chapter at the end will be getting to a lot of budgeted statements, which many of them looks exactly the same as what you learn in financial accounting. The only difference is that these are anticipated numbers. These are expected numbers, not the actual numbers. Okay, so what budget means is an expected plan for future. So all the statements at the end that we're getting to is all anticipated numbers, not the actual numbers. When we actually get to actual numbers, then we will do performance report compared it to. Okay, so if we list these budget's 3 main components and then decompose it into even more detailed boxes here, it will look like this. Okay, so the upper portion here, operating budget, again, it goes back to all the accounts from an income statement. Okay, so we will start off from sales budget. set a plan for future sales. What is the cash sales that we're getting? What is the accounts receivable sales that we're getting? So why do we start from sales? Why do you think we start from sales? What you receive after carrying out the plan. And also on an income statement, it's the first line, right? That's one of the reasons. And also remember that sales links to pretty much all the other components. You have to first sell products to customers, then you know what is cost of goods sold expense, right? Cost of goods sold expense is always, in the transaction, is recorded together as sales. After cost of goods sold, you may need to do more purchases because customers purchase a portion of the inventory, so you also need to plan what is your potential inventory level next season. Okay, so you need to do budgets on cost of goods sold together with sales. Usually we estimate a percentage of sales as cost of goods sold, planned cost of goods sold dollar amount. Then we estimate purchases. Do we have to make additional purchase in next season? And then what is our ending inventory level? Then from the first two boxes here, based on sales, again, we need to hire people, we need to rent places, so you have rental utility, you have depreciation on expenses incurred for long-term assets on the facility. All of these factors in operating expenses. All the additional expenses that are not covered in the second box. Okay, so at the end, if we link first three boxes together, that gives you the entire budgeted income statement. So the first four boxes here relates to operating budget. At the end, the goal is to get to an anticipated income statement. Okay, now, after doing that, then we consider capital expenditure budget. This relates to long-term assets purchase, long-term assets trade-in receipts. Any of the cash that we received, any transactions on long-term assets purchase or selling goes into this budget box. The remaining three financial budgets captures all the other information that we haven't captured in operating and capital expenditures. So we'll start from cash budget. Cash, again, is the most important of the entire financial budget. Remember, balance sheet starts from cash account. It's the most important asset in the business. Then we go on to budget the entire balance sheet, putting together all the assets, liability, equity information. Then at the end, statement of cash flows. Okay, so this entire structure is very important in budgeting. Basically, it's the same structure as we do the actual financial statements. Remember, financial statements and financial accounting, we start from the income statement, then we transfer net income into statement of retained earnings, which then is transferred to balance sheets, part of equity. After balance sheet, then we do statement of cash flows because statement of cash flows looks at all three statements, cash inflow and outflow. Right, so this entire budget structure is important to know, and actually it mirrors financial statements structure and process. All right, let's do a quick exercise just on the components, the structure of budgeting. If I give you A, B, C, D, E, F, G, and ask you to list the preparation steps of all these budgets, which one do you think is the first one? Sales, and then? Inventory, purchases, cost of goods sold. So you can think of this because every time you make sales, you also have cost of goods sold entry listed. So F is the second one. Then what's next? Cash is a little bit later. So it's actually missing one, operating expenses here. Well, let's assume it does have operating expenses. What is after operating expenses? Budgeted income statement, right? So the entire operating budget at the end, our goal is to get to budgeted income statement, and that will be the whole set of operating budget. Operating budget links to all the temporary accounts. So we start from sales, then cost of goods sold, then the entire budgeted income statement. Then what's next? Not yet cash. Guess again. Capital expenditures. So what we covered in previous chapter is the horizontal line that you saw in the previous graph. So the vertical line basically is all the operating budgets, and then the left-hand side in the previous chart, capital expenditure budget, okay, on long-term assets purchase and payment. Okay, then we arrive at cash budgets, which is the first part of financial budget. That's also the first account you see on the balance sheet. After this, then we get to balance sheet budgeted, links to assets, liability, equity together. At the end, statement of cash flows. Okay, so this is the general flow. It's pretty much the same as the flow we do actual financial statements. But then again, this is the budgeted part, anticipated numbers. Okay, any questions so far? All right, let's take a look at operating budgets, some more details. So again, we start from sales, right? This is the detailed components of operating budgets that we just went over. Sales, inventory, purchases, cost of goods sold, then operating expenses. Then all of these feeds into a budgeted income statement. So what does a sale budget look like? Looks like this. So see that, let's give you an example. Greg's Chiu's company wants to do budgets for the next 4 months, April, May, June, July. All these sales information, expect that the departments on marketing, advertising, they already have the information and they expect that the company's products is able to sell in the market. This is their anticipated sales dollar amount. Then some of the companies will break it down into detailed components on cash sales or credit sales. So remember that sometimes when you purchase something, especially you and I, if we use credit card, that's also considered not a cash sale. It's also the amount that you're paying later on. Right? So this is accounts receivable to the business. This is credit collections that they sometimes get next month. After they actually sell the products this month, they get the money next month. So the anticipated portion that they're getting for every single month's sales, 60% falls under cash sales, 40% is accounts receivables. However, altogether, the transactions falls under sales revenue. Okay, remember that whenever we journalize entry, whenever there are sales, that happens regardless of cash sales or accounts receivable sales, we still journalize all different types, right? Because accrual accounting, we're not just journalizing cash transactions, we're also journalizing some of the transactions that relates to cash receipt or cash payment later. It's still considered sales. Okay, so altogether, April we anticipate we're selling $50,000 worth of products. Next month, 30,000 more. June decrease 20,000. July 50,000 again. Altogether, we break it down in each and every month. A portion into cash sales, a portion that is anticipated as credit sales. Okay, so overall, at the end, what gets into income statement is this dollar amount, $240,000, adding up all the sales revenue together. So this is an example that a company wants to do budget for all 4 months together. They may also do it for 6 months. It doesn't really have a strict policy on how many months in a budget statement. So that depends on business. But as long as they list the detailed information at the end, what goes into budgeted income statement is the total sales revenue. So you will see this later at the end when we put together the entire income statement, the first line. Okay, so this is easy, right? Just simply listing the information, what is cash sales, what is credit sales. Now remember that sales dollar amount comes from whatever the number of items that a company is expecting to sell, the amount, and then you time the retail price. Okay, so if it's $10 for each product, 1,000 products, then you have $10,000. So after sales, what links to sales is cost of goods sold and all the inventory related numbers. Right, so budget determines, this area of budget determines at the end what is the total dollar amount of inventory cost, which we call the cost of goods sold. What is the anticipated ending inventory level after your expected sales? What is the dollar amount of purchases that you may need to make after sales entries? Okay, so after selling a portion of the product, turn it into cost of goods sold. You may have a lower level of ending inventory, and then you need to do budgets for next season. What is the potential number of products that you need to purchase, which goes into purchases account. Okay, so this area of the budget, literally just by its name, it determines all three numbers inventory, purchases value, cost of goods sold. So this portion of this statement, before we look at the table, links closely to this equation here. So I wouldn't really call it a math equation because really it's just the concept of how inventory flows into the business. Right, you start from last year ending inventory, which is this year's beginning. Then you make purchases. Whatever you sell minus ending inventory will give you cost of goods sold expense. Okay, so this is from financial accounting. We'll also review this a little bit in the beginning of this course. Okay, let's take a look at a inventory purchases cost of goods sold budget. So you can see that the first line here, we start from cost of goods sold, and then that total cost of goods sold amount, the blue highlighted number, 168,000, will also at the end go into income statement. And our income statement starts from sales, which we did earlier in the table. Then minus cost of goods sold, you will get to gross profit. Okay, so that's why we list the first line cost of goods sold here. And usually a company will have certain policies to determine their anticipated cost of goods sold level. So this particular example, they use 70% times whatever sales revenue that they're anticipating to get as the number of 35,000, 56,000, 42,000 each and every month's cost of goods sold. Okay, so what this means is from the previous table, you got the numbers here, right? This $50,000 times 70% will become cost of goods sold budget, $35,000. Okay, for the next month, $80,000 times 70% will become the $56,000 cost of goods sold. So using the same policy for the remaining months. So this is just one example. Companies can also determine it could be 80% of the sales. Then you will use sales revenue times 80% to get cost of goods sold level. Okay, so that's how you get the first line. If you're given sales budget, you're given the policy, 70% of sales, you can just use that to time the previous table to get these numbers. Now, desired inventory, also the same. Companies may set policies. This particular example, they set it as at least they want $20,000 in the warehouse and then plus 80% of next month's cost of goods sold. So what does this mean? Because we're budgeting this month's ending inventory. It must be something that we have to have left over in order to prepare for next month's sales, right? So they expect that ending inventory level to be at least $20,000 and then plus whatever next month's budgeted cost of goods sold is, 80% of that. Add it all together, this is the policy of how they get to that $64,800. So you will be using $20,000 plus 0.8 times $56,000 to get $64,800 for the first month, April. For May, you'll use 20,000 plus 0.8 times 42,000. Okay, so this is the policy. This will be given to you for each and every problem. What is the policy to determine their ending inventory, their cost of goods sold? So if you have cost of goods sold, you have desired ending inventory, add them together becomes the total inventory required in each and every month that they should have in their warehouse.
What about July? Where would we get the cost of goods sold?
July, then the problem will tell you the future month, what is their expected sales, what is their expected cost of goods sold. That is a great question because here from this table you can't see August cost of goods sold, right? So in the problem, if they want to complete one of these tables, then they'll definitely need to give you what is August cost of goods sold level. Then you can fill it into this, okay? Okay, so the third line here, total inventory required, basically is just adding up cost of goods sold and desired ending inventory for each and every month. Minus beginning inventory will give you at the end the purchases level that the company needs to make in every single month. So purchases meaning that since you're expecting the company to sell cost of goods sold certain level, you're expecting to have stored up ending inventory at a certain level based on the policy, you may need to replenish your inventory, you need to purchase more. So at the end, the last line here, purchases means what is the inventory value that you need to purchase additionally in each and every month. Okay, once again, the logic here goes back to this equation. So how do we get purchases? If you rearrange the beginning equation, beginning plus purchases minus ending gives you cost of goods sold. If you want to get purchases, that basically equals cost of goods sold level plus the ending inventory level minus your beginning inventory. Okay, so this factors in the table here. So again, from this first line cost of goods sold level, the company is budgeting to get at least 70% of sales. So 70% times sales will give you each and every month's expected cost of goods sold value. Second line, their desired policy for ending inventory is having at least $20,000 worth of inventory plus whatever level cost of goods sold is for next month times 80%. So that's how you get the second line, desired ending inventory. Okay, if you add those two together, that becomes the inventory level required for each and every month, the portion that you're either selling or the portion that you're leaving in the business. Add them together becomes the total inventory value. If you minus any beginning value, that will give you the purchases that you need to make for April, for May, for June, and July, that you need to replenish in order to fit May's cost of goods sold, May's ending inventory requirement. All right, are you following? Lost? Thinking about? Okay, so the summary of this, what we're trying to get out of this at the end is that blue number there, $168,000. That will be factored in income statement, because income statement we start from sales, then we minus cost of goods sold. The middle portion here will be used for cash budget at all the other balance sheet budgets. Because remember, balance sheet will require inventory level. So the middle portion here later will be transferred to balance sheet. Purchases, we will also need this for budgets, cash budgets specifically, because that relates to the inventory value that you want to get. So you need to pay these dollar amount to purchase this inventory. Okay, so a lot of these budgets information are actually linked together. Just from the first line, you know you'll need to refer to sales in order to get cost of goods sold. From this table, in order to get cash budgets, you'll need to pull some of these information and transfer to cash budget. For balance sheet, you will also need to refer to the ending inventory that you see here, transfer that to the balance sheet. So these budgets, they're not really independent tables. They're actually linked together. All of them factors in the 4 statements at the end. Okay, so we talked about sales, we talked about cost of goods sold, ending inventory, and purchases. Last portion before we actually get to income statement will be all the remaining expenses. So this is only the expense for inventory, right? After gross profit, the remaining expenses relates to utilities, rental, depreciation, right? So all the expenses, these are considered, we just call it the same category, in one category, operating expenses budget. So basically it's the income statement portion, the last portion before you get to net income. You have all the salary, commission expenses, rent expense, insurance on plant, insurance on the store, advertising of products, and all the other expenses that potentially the business will have. As long as it's a temporary account, it's not a long-term asset, it's considered operating expenses. Okay, so the middle part when we do budgets, a portion of these may link to the previous sales table as well, specifically the first 2 lines here. Okay, you may have commission expense, salesperson salary that links to how much sales have been given to customers, have been provided to customers. So you may anticipate commission to be 15% of sales, and you'll need to refer to that table of sales in the first month, $50,000 of sales times 15% to get the anticipated commission expense. So this is the budgeted commission expense. Company also has different policies to calculate these expenses. So it could be 15% or 20% of sales, that depends. But as long as you're given the policies, then you refer to the table to figure out the first line, the second line, and whichever expenses that the problem tells you is based on sales. So based on sales, that makes it a type of variable expense or fixed expense. Variable, because it actually floats with sales. Right, so this also goes back to Chapter 19 when we characterize expenses into either variable or fixed. Right, so the upper portion of variable expenses, when sales goes up, the commission expense goes up, miscellaneous expense goes up. As opposed to that fixed portion here, you can see that it's a recurring amount every single month. Okay, so the bottom ones here, for the long-term employees, not part-time ones, perhaps you have certain contracts for their salary. As long as they don't leave the company, then the salary expense, we can anticipate that every single year is there. Right, rent expense, also a fixed amount every single month. Depreciation expense, the same amount for these long-term assets. Okay, so the bottom portion here, in order to get to this operating expenses budget, definitely the problem will give you what is the anticipated fixed expenses, what is the variable expenses, and what is the policy for the variable expenses. Then you refer to the sales table to get the first two lines. The middle portion basically is a recurring amount every single month. Now again, if we take a look at the blue lines here, April through July altogether, we may be anticipating commission expense $36,000, miscellaneous $12,000, and the remaining fixed expenses. All of these numbers adding together 4 months will be transferred to budgeted income statement. Okay, so this will be the middle portion of income statement. For each and every income statement, we start from sales, which is the first table that we talked about, sales revenue. Then you have cost of goods sold from the second table. Minus these two, you get gross profit. Then you have all these blue operating expenses, which we break down to variable cost and also fixed cost, or you can say expenses. Okay, so after this, then you get operating income, and if you have expenses or gains in sales, then you have net income at the end. If you don't have any interest expense on this or any gains and losses on plan assets, then these two will be the same. Okay, the first budget table is this. Second, what you're getting is this. Third, you're getting is all the remaining operating expenses. Okay, so just to review very quickly, first table we just went over is sales budget. So you have at the end the blue line you want to transfer to income statement, the $240,000. Middle table here, for income statement, you will only need to pull $168,000 cost of goods sold portion. All the others are still important, but we're learning this later when we get to balance sheet, cash budgets. Okay, and then we have all the operating expenses. You'll be copying those blue lines, adding together the variable expenses, fixed expenses to these portion here. Okay, so if we combine all these three tables, you will get to this. $240,000 from the first table, $168,000 for cost of goods sold inventory table, and the remaining is from the last one, operating expenses. Okay, so all these numbers here are from the blue numbers from all the other exhibits, which the textbook also gives you, which table you can refer to. At the end, our goal is to get to this net income portion. Okay, so this $2,990 is the expected net income you can get after these 4 months. Okay, so we did a detailed budgets for May, for June, July, all of these, and also April. Add them together. This is the total expenses, total revenues, total inventory costs that we're expecting to spend and receive. At the end, you're getting operating income anticipated about $2,990. Okay, that's pretty much all I want to cover today for this new chapter. Basically, what is the budgeted income statement? What are the detailed components in it, the three main tables?